Jobs numbers came in much stronger than expected, but we shouldn't get too excited if we listen to David Tice, Chief Portfolio Strategist for Bear Markets over at Federated Investors. David says we are losing jobs at a slower rate, but that doesn't mean we are creating new jobs. He joins us on set along with Ajay Kapoor, Global Strategist at Mirae Asset Securities. So, David, let's get to it. Why shouldn't we get too excited?
Well, as you said, Carol, we are losing jobs a little bit less quickly. However, new jobs aren't really being created. The Challenger survey came out recently, the supplemental survey, and it showed the decline in new jobs being created was 60,000. That's essentially a 3-year high. So essentially the change in new jobs being created was 9 times greater than the change in jobs being lost.
All right. I'm just curious, Ajay, if you have any thoughts, because we were talking about you. You definitely have a more bullish sentiment.
You seem very bullish, but there's so many headwinds, and the labor picture is one of them.
Right.
Today we talk so positively about this jobs number, right? But we're still looking at 10% unemployment in the world's greatest country, and probably 9.5% by the end of next year.
Right. I just want to say one thing. I was maximum bullish in the summer, and I'm now bullish. So I have toned my bullish opinion down.
But not compared to David.
No, definitely not. Not in the bear camp at all. Now, on the unemployment rate, I think, unfortunately, we collect statistics on a country-by-country basis. But I think we got to look at unemployment and employment by an income-by-income basis. And because we're now in a global economy, and companies sell across the world, not in their own countries. And so that's why I think there's a de-linking between profitability of companies that we invest in versus the unemployment rate in that particular country. So look at whether rich people, affluent people, upper middle class people, are they employed or not, because they do a lot of the spending. So think about that for a second.
Well, that's why you can see the kind of run-up that we've seen in the market. You can see, as you point out, profitability increase at companies, even as maybe lower income people who aren't buying these companies' products are out of a job. Is essentially what you're saying.
Exactly, yes. And then they obviously need help from the taxpayer, from the government, and then that's being provided.
So in terms of any enthusiasm anybody's had about the job market today, obviously, David, you're going to say they shouldn't be excited, and I'm going to assume that you're going to say we should be a little bit excited.
We should be a little bit excited, and as I said, look at payrolls and the employment picture for people with large amounts of money across the world.
Let's talk about this from a policy perspective, because that's where you guys probably disagree most. Ajay is excited about the Fed's policy and policy of central banks around the world about stimulus spending because it boosts his investments, right? You can continue to ride that gravy train. Shouldn't you be excited about that as well? I mean, you're in the market to make money.
I'm not a fan of Keynesian theory, Matt, and I don't believe that we should be cutting interest rates right now. In fact, we need to get back to producing and not just encouraging people to go spend. I remember the famous line from Bob McTeer. He said it in 2002, everything will be all right if we all hold hands and buy a new SUV. Well, that seems ridiculous to me. We got in this problem with too much debt. Now we're piling more debt on the system. Investigator General from TARP said it might be $23 trillion cost to the taxpayer. We don't see any way that we're going to get better off by spending more money.
All right, but David, we didn't have a choice. I mean, we were in a huge mess. I mean, governments had to spend an awful lot of money or throw a lot of money at this situation to avoid maybe an even worse crisis than we lived through, correct?
Well, potentially we needed to do something to keep the system from freezing up. However, I'd like to point out 1920 to 21. This was talked about by a great book, Tom Woods' Meltdown. The 20 to 21 depression, GDP was down 17%. Unemployment was at 12%. What Harding did is he cut taxes, he cut government spending by about half, the government debt went down by a third. You know what happened? Unemployment went to 7% and 2% over the next 3 years. Unbelievable, because we stayed out of it.
I wonder, Ajay, you're excited when the Fed governors are being cautious and scared, as you say, and helping out. This is good for you in the short term, but are you concerned about it in the long term? Because David obviously is looking at this picture from a big step back here, really worried about what we see down the road because of all the stimulus and all these policies.
I kind of agree with that, because the U.S. debt situation, even the way it's printed by the CBO and other forecasters, is ugly 5 years down the road and 10 years down the road, where the interest component of that of the deficit is going to become so large that people are going to begin to think about, is this a Brazil-like situation? I don't think it's going to get that bad, but in the long term, I absolutely agree that there needs to be an exit. I just don't think it needs to be right now.
Interest payments on these deficits must be scary, right? We were looking at that months ago.
Well, and in terms of exit strategy, David, I'm assuming you're saying it does need to be right now.
Oh, I think we need to quit spending money. As far as the numbers, we're talking about 2019 adding to the national debt by $13 trillion. That could get us to $25 trillion. If interest rates are at 10% on $25 trillion, $2.5 trillion. Do you know what the amount of total revenue to the U.S. government was in 2009? $2.1 trillion. Therefore, at 10% interest rates by 2019, we could have interest expense exceeding revenue.
But to be fair, your policy prescriptions call for a cut in spending, basically, that would, I think you admit, lead us deeper into a recession before we can recover again, right? I mean,
people need to start thinking about long-term rather than short-term. Every government policy and prescription has been fix it for the short term and don't worry about the long term. We have to start thinking longer term.